Jason Watson with WCG Incorporated here in Colorado Springs. We're a local tax and accounting firm. I'm joined by Rachael Weber and Joseph Bassett, both tax professionals for us. We're also hosted by Axe and the Oak here in Colorado Springs. They've been gracious enough to open up early for us, part of our Bourbon and Business series, podcasts and videos. We just got done wrapping up a video and podcast on some of the bigger deductions that we see. Cars, that's always a big one for most small business owners. Meals and travel. We're going to talk this time around about home office, and then all the other like goofier ones, if you will. So, tell me the rules, Rachael, on the home office deduction.
It's got to be used regularly and exclusively in your home. Mm-hmm.
Okay, regular and exclusive, and have a business
purpose.
Yeah, and that's probably true for every deduction on the planet, right? For a business deduction to be a legitimate business deduction, it has to have a business purpose. So use regularly and exclusively. So can you break those words down for me? What's regular mean?
Regular means you would be checking your emails, invoicing your customers, doing administrative work, meeting with clients, holding your inventory. It could mean a whole host of things. You're just doing that on a regular basis, not once a month, but on a regular basis.
Yeah, and one of the words that the IRS will also use too is continuous, right? This is regular and continuous. It's got a life, it's got a cycle. So yeah, absolutely, regular is a big deal. We have folks that have one rental. They have a W-2 job, they have all those things, and they're trying to say, I have a home office to manage my rental. It's just never going to happen. Now, if we have 10 rentals, 6 rentals, that's all you do is manage your rentals. We have some people that have 3 or 4 VRBOs or Airbnb short-term rentals, and that is all they do. They're working that stuff 100%. So, so that's regular. How about exclusive, Joseph? What's exclusive mean?
So let's say you have an extra room in the bedroom that you want to use for your home office. It also can't be your theater room. So, it's got to be exclusively used for business.
What if you're a videographer and the theater is your business? Well, I'm teasing you.
You have an argument there.
But you can't mix the use. Yeah,
right, unless you run a daycare at your house as well.
Yeah, and daycare has its own special rules, and this is not the podcast for that because I don't know those rules by memory. I look them up once in a while when I have to, but that's it. Those are some of the shared use stuff, can be daycare. Other than that, it's regular and exclusive with a business purpose. So tell me some of the benefits of having a home office deduction or home office reimbursement.
Reimbursement is that part of your mortgage interest, your real estate taxes, your utilities. Could become a small deduction for you, a business deduction.
Yeah, absolutely. And what are some of those expenses that aren't otherwise available to be deducted? In mortgage interest, we say yes, right? Schedule A. Property taxes, we say yes. But how about the other ones?
Utilities, insurance.
HOA dues.
Yeah.
Repairs.
Okay, so suddenly those become deductible in a world where otherwise they wouldn't be.
Right.
Yeah, okay. And how do we calculate that home office deduction?
Well, we do it by square footage.
Yeah, that is probably the most common is square footage. You could do it a room by room. The IRS allowed, they actually mentioned that in publication, 587 or whatever it is. But I've never seen anybody do room by room. It's always usually, I shouldn't say always, but usually it's square footage, So what's the basic calculation? It's the home office space divided by
total space of the house.
Yeah, the total space of the house. What if you use your garage? Then what do?
You include it.
Include it where?
In both.
In both numerator and denominator? Yeah, exactly. So if we're going to take the benefit of the garage and it's not otherwise in the denominator, then we have to add it in. Yeah, exactly. So that's home office. What's this 50-mile rule thing? Who wants to talk about that?
Right. So the 50-mile rule is, kind of a safe harbor, if you will, that if, your home office is within 50 miles of your tax home, then you can, deduct the expenses associated with communicating from the tax home to the home office.
Yeah, exactly. They being the IRS and the tax court, they want your home office to be, and there's no written rule on this. It's more of a contrived rule, but your home office needs to be within 50 miles of your tax home. Your tax home is where you earn your revenue. So the great example in one of the tax court cases is a surgeon had a home in Pennsylvania. He drove to New York, I believe, and it was 130 miles away. He was attempting to deduct all those commuting expenses. And because he was like, well, I got a home office. So then my commute is from my bedroom to the basement. And then when I hop in the car, it's all business miles. And of course, the IRS and tax court said no. They said it's too far from your tax home, basically. So they disallowed all those expenses as deductible expenses and considered them commuting expenses, which is normally a personal expense, non-deductible. So that's this 50-mile rule. Talk to me about the audit rate risk for home offices, and you've been doing taxes for a little bit of
just a little while, right?
Yeah. So tell me a little bit about the history.
Yeah, and it's almost like they can walk in and assume you're doing something wrong because they're not easy rules. And maybe the square footage isn't complete, or they can say, "Hey, what's with the day bed in your home office?" And it's not just the deductions that you're getting, your utilities, your small amount of additional square footage, but it's that commuting miles that it's going to be pricey if it's not done right.
Yeah, absolutely. So home offices 20 years ago were not very common. So it was a high audit rate risk. Today, telecommuters and all that stuff is a lot higher, but now we're back to not being seen very often, because if you're a W-2 individual working out of your home office for a company out of California, you would have to deduct that on Form 2106. And those expenses, those deductions are no longer allowed. So home office has almost been shrunk down to just for business owners. Yeah. So how are we going to do that? Joseph, talk to us about how we're going to do the home office from an S Corp perspective.
So we'll use an accountable plan for the home office for the S Corp, and one of the reasons why we do that is, S Corps are cash basis, and typically,
small businesses enjoy using cash as their method of accounting. It's simple,
depending on their gross receipts. Yeah. And we have you record it, for like Rachael said, your interest, taxes, insurance, and then you get reimbursed by the S Corp for your business use percentage of those expenses.
So just to back up for our viewers and listeners, an accountable plan is the method used to reimburse people, employees, for business use of their personal assets. Car, cell phone, home are probably the biggest ones, right? So, and we forgot to put cell phone down on our big list of deductions, but we can talk about that in a second. So the benefit to that is we're getting reimbursed by our business. That expense is kind of tucked away on the S Corp tax return, using an S Corp in your example, as occupancy expense. Not that you can't defend it, not that we're doing anything wrong, but it certainly is not as high of an audit rate as filing Form 8829, which is clearly the office and home worksheet that gets tucked on or tacked on to your Schedule C if you were to have a business only on your 1040. So that just shrinks dramatically the audit rate risk from home office perspective.
And two, S Corps already face a lower audit rate themselves.
Yes, 0.4%, given I think 2017 data is the latest that we have now. So the IRS takes forever to compile this stuff. I mean, I guess it makes a little bit of sense because audits take time to generate and to do. But I'd still like to think we can live in a real-time world. You know what I mean? Like, we should know, like, right now how many audits are happening. So, all right, let's talk about commuting expenses. You get up in the morning, you drive to WCG Inc. Is that an expense you can deduct?
No, it's not.
Okay. Are you bummed out about that?
Yes, I am.
Yeah, okay. Yes. We should write our senators and our congresspeople. So commuting expenses, no. Even if you travel far, let's say you moved to Denver and you drove every day down to Colorado Springs, doesn't matter,
Still
right?
personal, yeah.
Right, so there's no like, hey, we recognize that you're traveling really far, we'll give you that deduction. There's nothing like that. So commuting expenses, parking, tolls, all that associated with going to your tax home, if you will, are not going to be deductible. So great. Country club dues, Rachael.
No, can't do it.
No, wow. Just hammered.
Sad,
Boom.
yeah.
Talk to me a bit more about that. So we have someone who has a membership somewhere, but they do entertain. Shouldn't say that.
Nope.
They do,
Discuss business.
Yeah, they do discuss business at their country club. Mm-hmm. How does that work?
Those expenses for the country club dues are going to be personal. It's
Right.
great that they're generating business
Yes.
at the country club,
Okay.
but the dues are not deductible.
All right. So this same member buys a meal. The business purpose is clear. They
Yep.
were there to discuss business. And now this individual is buying a meal that's going to get tacked on top of his or her dues. How does that work?
That meal portion is going to be 50%
Okay.
deductible as a business meal.
Just like we've always done with meals. Okay, great. Talk to me a little bit about education. Can you run education expenses through your business?
It depends.
It
So,
depends. Just
if it-
the classic accountant.
Yeah, maybe.
Yeah.
If those education expenses are to improve your current field, then possibly. If they're to do something completely different, so if I was going to go to school to become a doctor now, which probably won't happen,
Yeah.
but those wouldn't be deductible.
Right. So the rule is it has to improve your current work skills. And you can even deduct a degree or even college courses, even if it leads to a degree, provided it's improving your current work skills. So you're absolutely correct. The other half of that is if you need it for certifications, like your continuing educations and all that stuff. So people who are CPAs have to go do all these nauseating continuing ed credits. I'm sure we learn a lot too, but anyway, so that's education. How about your children? Can you hire your children and consider them employees and have the company pay for the education? Who wants to take that one?
I would say yes.
I'd say no.
Like the client advocacy in me would say yes,
Yeah.
but because of the relation, though, it'll be disallowed.
Right. Yeah, I was giving you a hard time. So Section 127 says if your child is 20 years or younger, they have attribution to you as mom and dad being an owner of the company. If you own 5% or more of the company, you can't deduct that education. But if your child legitimately works and is 21 or older, so we're talking junior, senior, if they're on a
college.
6-year plan, it might be a sophomore, right? Then the company can pay up to $5,250 a year. I think that's 2019's limit. So that might get indexed every year like everything else. So anyway, that's education. How about client gifts? How do you handle that?
Oh, they're $25 cap. I know. It's really.
$25?
Yeah.
But they give you the $4 for gift wrapping.
And they give you $4 per pen or something.
Yeah,
Is
per
there like a
pen, yeah.
per
That's
pen?
advertising, yes.
So talk to me more about the $25 rule. Is that like all gifts or is it just for gifts to specific people?
It's gifts to a limited clientele. If you were handing gifts out to the general public and it was a lower cost, then that would be considered advertising.
Okay.
And I think they give $4 for each advertising gift,
Yeah.
which I'm not quite sure what, a pen or a calendar or something like that.
Yeah. I don't know how
Yeah.
much that stuff costs either. Yeah.
But
from
your
what I-
$75 wine basket is going to be a $25 business gift.
Yeah, and as I've seen it, read it, maybe in Journal of Accounts, other things like that, that's an individual limit. So if you don't donate, or if you don't provide that gift to an individual, if you just do it to the business, there might be different rules
Yes.
allowing you to take more deduction. So if you say, "Dear Bob, thanks for all the business,"
Versus staff at.
yeah, exactly.
Yeah.
Exactly. So, and you can see why. The IRS is always worried about transfer of wealth without taxation, right? So if you
Kitty
come in
tax.
there with a bunch of client gifts for one person, it might look like a transfer of wealth. So, how about professional attire? I am rocking the WCG
It's true.
on
Very
my shirt
nice.
here, but tell me about professional attire. People will constantly ask you.
Yep.
I have to look good in my business suit. I have to have my nails and hair done. I have to rock this image.
And they're all personal.
Yes. Even though they're dead sexy, right? Even though they're very good
and
looking.
necessary.
Yes.
Absolutely necessary.
Yeah.
So there's a business purpose behind it, but no tax deduction.
Right. So what's the rule?
If it's not suitable for everyday wear.
Yes. So
then you
if
can
it's
deduct it.
if it's suitable for everyday wear, easily convertible into everyday wear, then it's not deductible, right? Business suits are clearly something you can convert to everyday use. We do have some TV personalities. We do have some models, and we can identify some of that attire as costumes, something that they wouldn't be caught dead in. And that's true for some of these models for sure. They wear stuff and they're like, I'm never wearing that in public. It looks good on a cover of a magazine, but that's about it. Those are costumes. They're not suitable for everyday use. Those are something that we can deduct. TV personalities, they'll buy 1,000 jackets and they'll give them away, and so those become marketing toys or ploys or whatever. So absolutely. Let's talk about per diem, and I'll just kind of talk about this real quick. Per diem's a funny thing. If you own 10% or more of a corporation, and also there might be some attribution there where if your brother or your sister or your mom or whatever, then you are assumed to have the same greater than 10%. If you are in that boat, you cannot take a per diem reimbursement. So the scenario would be like this. I'm 100% owner of a corporation. I pay myself $71 a day for every day that I'm in San Francisco, because that's the per diem rate. Let's say using 2018 numbers, I haven't seen them. I haven't looked at per diem in a while because we don't see 2106 expenses anymore, but that would not be allowed. WCG Inc. says, Rachael, we need you to go to, let's say, Cortez. We really didn't like you very much. I'm teasing. Cortez is lovely. But and we say, hey, we're going to give you $71 per day that you're there for meals. That would be acceptable. And that would not be revenue to you. You maybe only spend $20, whatever. You still get to take that $71 as tax-free income. So because you don't own 10% or more of WCG Inc. That'll change. You'll own own it all. And
85%,
Joseph and I will be working for you one day. It'll be awesome. So, but that's per diem. Per diem is a little tricky. There is the meals and incidentals component. There is the lodging component. The meals and incidentals component, as far as I know and read it, is available to Schedule C, sole prop, single member LLC types. The minute you're a corporation or you act like a corporation through an S Corp election, that gets tossed out the window. Lodging, regardless, is always going to be actual expenses. So you don't get the high-low seasonal rates and all that stuff that you see in those per diem tables as a business owner. So we ran through home office, all kinds of good stuff there. We ran through all kinds of other deductions that we get entertained with, quite literally, because some people are pretty clever, right, with their deductions. The bottom line is, people ask me all the time, and they ask all of us all the time, how do I save on taxes, right? And the first thing I say is, look, your job is to build wealth, not save taxes. We can save taxes along the way, that's great, but your job in life is to build wealth. Now, if you still want to save taxes, the trick is to look at what cash you're already comfortable with leaving your body. So go through your checkbook and try to figure out if there was one thing that you missed, or maybe this expense really did have a business connection to it and I forgot that it did, or to dig deep. So it's to look at the money that you're already willing to spend and try to find a business connection. Now, I say find a business connection, like discover a business connection.
Not create.
Not fabricate a business connection. So anyway, those are some of the other business deductions that we see a lot of. Commuting expenses, country club dues, education, client gifts, professional attire, per diem, all that good stuff. We talked about home office in this segment as well. We didn't talk about cell phones. Cell phones, folks will try to deduct 100%, right? Oh, I use it for my business. Oh, I know you use it for your business. I see that. But the minute you get a text saying, hey, honey, you're out of beer, you should probably pick some more up on the way home, and milk and eggs are low too, now your cell phone is no longer 100%. So, our firm-wide soft ceiling is around 80%. If you're a realtor, you're probably on the phone all the time. People have kicked landlines to the curb, but still, your phone is going to have a high personal use, and we believe as a firm 20% is about the minimum there, meaning 80% is for business. Maybe you're a dentist, right, and you use your cell phone occasionally. You have an office phone and all those other things, so maybe that's like 30% business use and 70% for personal. So commonly we see cell phones being paid for by the business, and they truly are a mixed-use asset. So a mixed-use asset should be
paid by you personally,
exactly.
And then reimbursed through an accountable plan.
Yep. So assets that you own personally should be paid for personally. If there's a business connection or use of that asset, then get reimbursed. No different than you working for Google, and Google says, hey, drive down to the store, pick up some pencils, and we'll reimburse you. Well, you bring in a receipt and you bring in your mileage log, and maybe you have to use your cell phone and all that stuff, and they would cut you a check for the business use of your personal stuff. So anyway, those are some of the common tax deductions that we see here at WCG. My name is Jason Watson with WCG. Alongside Rachael Weber and Joseph Bassett. We're at the Axe and the Oak. This is a part of our Bourbon and Business series of podcasts and videos, and we thank you for joining us, and we'll talk to you real soon.